Welcome to the Retiring Real Estate Investor podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Welcome, everyone, to another episode of the Retiring Real Estate Investor podcast. I'm your host, Brandon Bruckman, and I'm joined by another Brandon. Brandon Hall, how are you?
I'm good. Thanks for having me on, Brandon.
This won't be confusing for anyone. Maybe we'll change my name for this one. My parents, the second name is Philip. They wanted to use. So maybe I'll be Philip today. You can continue to be Brandon. Maybe we'll operate that way. Maybe that's more confusing.
My parents thought that I was going to be a girl, so they had picked out Ray. I was going to be Ray.
Oh, yeah. Okay. So maybe this is the Philip and Ray podcast today. We'll go alternate names.
Philip and Ray.
Philip and Ray are going to do this today. But I want our listeners to know you are a CPA, the first one we've had on the show, and now we're going to beat you up with all the CPA questions. But this is perfect. So you founded and started your own CPA firm, Hall CPA, and you're specializing in addressing real estate investors, 700 plus clients across the nation. You are an in-demand person. Tell us a little bit about kind of how you got started and why did you turn to focus on real estate?
Yeah, so I started the firm officially in 2015. I tell people like really 2016 because 2015 I netted like 4K, so sometimes like it doesn't count. But 2015 was the official start. I went full time into the firm Q3 of 2016. But what started the whole thing is I bought a 3-unit property early 2015. I found biggerpockets.com because I was trying to ask questions about how do you buy this rental property? How do you manage it? And through that whole process, I realized there were a lot of people asking tax questions. And at the time, there were very few tax people answering those tax questions. So I just started answering the tax questions. I was studying for the tax portion of my CPA exam at the time. So it's just like a fun exercise to do on a daily basis. But that it kind of became a little addictive, like answering all those questions and getting positive feedback. And after a while, somebody, I forget who, people were reaching out asking if I was taking on clients. And finally I just like, I'll try to take on a client, see how this goes. Mm-hmm. That was probably middle of 2015. And then I just kept accelerating it. And so then 2016 was able to have enough of a book of business to go full time. And today we have a team of 40 in the U.S. and then we have 24 overseas between India and the Philippines. And then we service about 700 clients nationwide in the United States. Everybody's in real estate, 100% real estate investors. But yeah, we've niched really far down, and we provide tax planning services, tax compliance preparation services, and accounting services. What
a great way to know that you're onto something when people ask you to provide them the service when you haven't actually started the business yet. That's when you know.
Right, yeah.
You found something.
My original sales call. Yeah, I mean, I had no idea how to run a business. I had no idea how to sell anybody on anything. I mean, my original sales calls would go like 2 hours long. And it wasn't until my girlfriend at the time, wife today, was like, you're wasting a lot of time and you're giving all the value away for free, that I really started trying to figure out how do you actually do sales. But yeah, and now our sales calls a day are like 25 minutes. So
there you go.
It's great.
There you go. Perfect. Nailing it. So we've talked a little bit beforehand, reveal some of the secret sauce here a little bit, but we talked a little beforehand. You've had a lot of very topical LinkedIn posts lately that are right on par, I think, for our listeners. And the first one I wanted you to kind of get into, maybe elaborate a little bit on, is you posted one on 1031 exchange and why investors may want to consult their CPA before they go jumping into exchange. You actually posted some of the tax docs to show exactly where folks should look. Can you kind of walk our listeners through that? Why should they be thinking about, hey, maybe 1031, I might not need to do that? Where should they be looking? What should they do?
Yeah. So for some context, 1031 exchange allows you to defer the capital gain and the depreciation recapture from your rental property as long as you're trading up and following all the rules. So you're selling one property and you're buying a larger property. That's what a 1031 exchange does, and you just kick the tax can down the road. Most investors, when they get around to selling their first investment property, they know that a 1031 exchange exists. And so the default mode that they go into is 1031 mode. I have to go and do a 1031 exchange because that's the thing that I know that all the other investors are doing, which is true. A lot of investors use 1031 exchanges. But what we have seen is investors will be halfway through a 1031 exchange. They'll switch to us as their new CPAs. We'll take a look at everything and realize, oh, you have like $200,000 of suspended passive losses that you're carrying forward. And this property that you're doing a 1031 exchange on only has $150K of gain. So you don't have to do the 1031 exchange. You can if you want to, but we're a big fan of time value of money, using what you can today, not carrying it forward if you don't otherwise have to. So that type of person, we would say, don't do a 1031 exchange, just sell the property. And now you have 50K of suspended passive losses rather than 200,000. So my LinkedIn post, I was educating people on where to look in their tax returns. And the form is Form 8582. It's the most important form that real estate investors need to know. Not only is it going to help you with the 1031 exchange, but it also shows you that all passive activities net out against each other. So we get this question all the time. Well, if rental A generates a loss and rental B generates income, my tax person says they don't net out. Yes, they do. Well, I invested in an LP and that created the $50,000 tax loss, and my tax person says I can't use that against my rental A income. Yes, you can. Well, I invested $100,000 into a hair salon and it generates $10,000 of passive income, and my rental over here generates a $10,000 passive loss, and my tax person said I can't use it. Yes, you can. They all net out. So anything that's passive will net out against each other. And Form 8582 is where that netting happens. So whenever you get that sort of pushback, I've tried to educate investors that are in our ecosystem to ask, well, can you prepare me a draft Form 8582? Then prove to me that these things cannot net out, because they're not going to be able to unless they do some manual entries, which would not be good. But that's that most important form. And that form, it tracks your suspended passive loss carrying forward. So, it helps you with the 1031 exchange decision. But imagine switching CPAs and the new CPA forgets to carry forward that suspended passive loss. That you would have no idea if you weren't tracking Form 8582. You would have no idea. And we've run into that several times. But it's okay. People, CPAs, I think most tax pros are good. I think that most tax pros are good at the jobs. They have high integrity. But the reality is, if it's April 1st and we are just screaming, we've got a ton of tax returns to do, we're going to make mistakes. The best shops are going to make mistakes. So you protect yourself if you know where to look in your own tax return. So if you switch CPAs and you have a $200,000 loss last year and all of a sudden this year you have nothing and nothing's changed, that's the time where you get to say, hey, I noticed on Form 8582, my suspended passive loss is not carrying forward. And you've just saved yourself a lot of future headache.
So the big thing to think about is the suspended loss that you may have there and doing that 1031 or not. Strategically, we'd sort of look at that and say, hey, look, here's a great opportunity for you to use that loss and then to reset your basis on depreciation on that asset. Because as a lot of our listeners will know, your 1031 schedule, your depreciation schedule carries with you when you're doing that 1031 exchange. Here, you could use that loss and reset yourself. Are we thinking about that the right way?
Yeah. Yes, you are thinking about it the right way. But if you kind of consider what you're really doing you are effectively doing a 1031 exchange. You are still transferring your basis over to the next property, even though that one property has reset. the entire portfolio is still the same because you're using this suspended loss from the portfolio. So some property somewhere doesn't have basis anymore is effectively what happens. So you're on the right path. It's without getting like super into the weeds, you are correct. But while you reset the basis on that one property, the other properties now have less loss when they eventually sell. So it all will equal out in the end.
I see. So then maybe some of these considerations would come down to timing and thinking about, because that's an equation that we could take. That's something we could take out of the equation is some of these timing issues that you're experiencing. Could do that in this scenario where you're not actually executing the 1031.
Definitely.
So there's a variety of things there you kind of think your way through a little bit. But yeah, I get what you're saying there. You're sort of shuffling the deck a little bit, but from a portfolio perspective, not much of a change there from where you think about that from an economic standpoint.
Right. And the timing thing is a big consideration with this is like once you understand you can use losses from one property to offset income from another property or gain from another property, your world kind of opens up. Like if I could do 1031 exchange and that makes sense, sure, but I don't necessarily have to. Consider I buy a property on January 1st and I cost segregate it and it creates a $300,000 tax loss. But then I sell another property on December 31st for $300,000 of gain. Well, if I've gone through good tax planning, I know that my January 1st property is going to offset the gain on sale from the property at the end of the year, and I don't have to do a 1031 exchange. So it's like it is still kind of like transferring basis around though, because now my January property is $300K less than it otherwise would have been because my December property just used all those losses.
There's a couple different ways to think about this. This brings up a good, when you're describing that as well, you mentioned some of the passive for passive offsets on gains and losses. So what we experience from a lot of our investors and listeners are experiencing is going from an active real estate investor to now really a passive real estate investor. Can you talk about some of the ways taxes are going to change dramatically for these folks? Can you talk about some of the ways that they should be thinking about things as they go from active to really passive from a tax perspective?
Yeah. So when you are actively involved in real estate, you are typically like a real estate agent, you're a flipper, developer, or you're a full-time landlord. Or not even a full-time landlord, you're a part-time landlord, but you have nothing else going on. It's the thing that you do. Excuse me. When you are actively involved in real estate, you can qualify as a real estate professional, assuming that you are working in a real property trade or business and you meet the two tests to qualify as a real estate professional, which is to spend 750 hours and more time in real property trades or businesses than anywhere else. So if that's what you mean by going from active to passive, what you really have is, as a real estate professional, I'm creating non-passive losses. So this rental property that I go buy for $1 million that I cost seg and bonus depreciate, that creates a tax loss of $200K. If I'm a real estate professional and I'm materially participating in that property, then I can use that $200,000 tax loss to offset any other of my income, any type of income, my W-2 income, business income, gain on stock sale, retirement account cash outs, like any type of income. This loss can offset as long as it doesn't get phased out with the excess business loss limitations, which we don't need to jump into. But that's the key. I can use this loss to offset any income. When I move out of being an active real estate investor and into a passive real estate investor, everything just becomes passive again. So typically with our clients, what we see is somebody might be passively investing in real estate. Like they built their portfolio. Now they're handing it off to a property manager. They're going to go travel the world. They're going to get all their time back and their portfolio is still cash flowing. But by that point, it doesn't matter if they qualify as a real estate professional or not, because the vast majority of their income is coming from their real estate. And if your real estate is all passive, it's just all going to offset each other anyway. So I could have 10 properties that produce net income. I could have 10 properties that produce a tax loss. Maybe they still produce net operating income, but after depreciation, it's a tax loss. And the 10 that produce income, the 10 that produce loss can all offset each other. And I don't have to be a real estate professional for this to happen. It's just all naturally happens.
Mhm.
So once you kind of build the portfolio, it is interesting. I was actually on a podcast earlier today talking about this exact same concept. When you get to a certain size portfolio, qualifying as a real estate professional starts to not matter, because what matters is making sure that my real estate portfolio itself nets out against each other, that I'm creating tax losses from my new properties that are offsetting the net income from the old properties.
I got you. Okay. So that makes a ton of sense there. That, see, this takes much more planning. And you've also made a really good point in talking about sort of some of the complaining that you hear maybe a little bit about the proactive versus the reactive from a CPA standpoint. And, as I described you, I sort of sit in between these two relationships between our clients and some of their CPAs. And it's definitely a two-way street. And I think you recently posted about this as well. This is a great example where someone needs to be proactive and engaging their CPA. Can you discuss that a little bit and how investors should approach that?
Yeah. So the post that you're referring to is something that I hear a lot of. Both, like I've started helping some CPA firms kind of think about how can they provide better services to clients, how can they structure their practice to not only become more profitable, but just make a name for themselves in a niche. And then I've also obviously heard it from the client side of the coin too. And sometimes we get it from clients that are like, you guys aren't proactive enough. It's like, okay. The problem is the economics of the problem is embedded in the economics of how you actually run a CPA firm. In order for a CPA firm to be profitable, I have to charge enough money to enough clients to hire a strong CPA to service those clients, and then support that CPA with a strong technical team that allows that CPA to spend more time working with clients rather than actually doing the tax return or actually writing the tax plan, right? And to get those economics is really hard to do, especially if, like most CPAs, you charge $800 for a tax return and then you charge hourly fees whenever people contact you. Because what happens is you might contact me and I might not feel comfortable charging you hourly. Like I might answer your email. It might take me 30 minutes and then you never receive a bill for it, mainly because I'm skittish. A lot of tax accountants, I think, go through this where they are just like, well, it wasn't that big of a deal. Yes, it took me 30 minutes, but it's not that big of a deal. So I'll just, whatever. It's not that big of a deal. But they're doing that with like 20 people, right? And so when that starts adding up, you can start to understand why this CPA or tax accountant is never being proactive with you. It's because they're not charging what they're worth. And so my whole post was, if you're one of the clients that's like, man, my tax person is not being proactive, they're just reactive, they only answer when I email them, you probably have a tax person that hasn't figured out the true economics of their firm. And I know that sounds silly, but the reality is that a lot of CPAs, once they become a CPA, they can just go and open up a practice. Doesn't make them a business owner, just means that they're just going to go and do their own thing. They'll make $150K and they're happy with it. But that's not going to be somebody that is going to figure out how to do this proactive thing, because they're not figuring out the economics of their firm. So the post was basically, if that's what you're feeling, but you like your accountant, reach out to them and tell them, hey, I would like for you to be more proactive, and I would love to pay you to be more proactive. Not hourly, because what I just said about hourly, CPAs get skittish about charging hourly. Attorneys don't, but CPAs do. So CPAs are all scared to bill you hourly. So don't offer that. Say, hey, I'll pay you $3,000 if you meet with me 3 times a year, and if you are able to, once a quarter, give me a small write-up on what you think I can do to improve. Boom. That's probably worth $3,000 if you're investing in real estate. Our plan, we have an advisory plan for our ongoing clients, and it is $3,000. We do 2 calls a year. We do email support, and we'll follow up once a year with like an update to their tax plan. And that's honestly enough. Like, that's proactive enough for most cases. So that was kind of the crux of the post, is just, if you're feeling that, then pay up. If you don't pay up, you can't expect any sort of change, because the economics aren't there. They have to work with 500 clients to make money.
It's a tremendous point in seeking what you want. You're seeking value as the client of that firm, and then for the vast majority of our clients, they're happy to pay for anything they see value in. And so that's a great reminder, I think, for some of the investors and the clients of the CPA firms, that you may be dealing with this call it a stigma or skittish, as you referred to, but they're skittish about charging hourly. So hence they're skittish about providing that value. Show them that it's valuable, right? Sign up and say, hey, here's what I think this
Yeah.
is worth for you guys. And wow, does that it makes everyone happy, right? I'm getting the value that I want. CPA
Yep.
is getting an extra stream of income that they're getting likely during the off season, if there's an off season anymore. Likely during that off season, here comes an extra stream of income. That's really valuable for everybody.
Yep. Yep.
You're
And
on
here's
to
what's
it.
going to happen too, right? So you're going to say, all right, I'm going to pay you $3,000 to meet with me 3 times a year and to give me a quarterly write up on what I can do better. Your CPA is going to go, okay, 3 times a year, that's 3 hours plus a quarterly write up. That's probably 4 hours. My hourly rate is $200, so that's $1,400. He's offering me $3,000. No, I don't want to take $3,000. I'll just take $1,400. And you say, no, I'm going to give you $3,000. Right? Because again, CPAs do not charge what they're worth, and you're trying to create a proactive relationship. You want to be the number one client for this person. So
Mm-hmm.
pay them for it, specifically for it. Get an engagement letter drawn up. Don't just agree to this over the phone and send them money. Get an actual engagement letter. Get the scope of work on paper. And what'll happen is that CPA, you'll be the only person that they're doing this for the first 6 months. Then the CPA is going to go, wow, this is actually working for me. This is profitable. And I'm going to start doing this with all my clients. And what you will notice over the next 2 years, now granted, I don't know if you want to wait 2 years, that's up to you. But if you do, what you'll notice over the next 2 years is that the relationship gets better because the CPA is quietly shedding clients on the back end who are not willing to pay them $3,000
Mm-hmm.
for that relationship. So your service will ultimately get better. It will take time, but that's really what's going on with your CPAs. When you say, oh, they're not being proactive, it's not because they don't want to. It's because they don't understand the economics of their own firm. They don't understand what's super important to clients, and they don't know how to price it. And that's so you can help them with it. You can help them with it.
Exactly. There it is. Yeah, two-way street there. You got to help them start this and do this in their business. What a huge thing to do. You mentioned something in there about sort of quietly shedding some clients. I've seen sort of overtones of this in the space. Are you seeing this as well, where there doesn't appear to, like most industries, but most acutely here, there doesn't seem to be the same volume of CPAs ready and willing to take on clients. Have you seen sort of this shedding as well in the space and this happening?
Yeah, it's a big deal. There's a lot of CPAs that have left the industry. Either they just decided to retire, or what happens more commonly is they go into industry accounting, where you can have a steady 35, 40 hours a week and get paid $100K to do it. You got to remember, like most accountants are not business owners. They don't want to make $500K, $600K, $1 million. I know that sounds absurd to real estate investors, and that's probably one of the main reasons that there's such a massive disconnect in like the value prop that most of these accountants provide. But most accountants don't want to run something like that. That's a big undertaking, and you have to be an entrepreneur to get that done. So instead, the better option is, well, I'm going to go and just work for a corporation in their tax department or in their finance department, and I'll never exceed a 40-hour work week. And I'm going to have a great work-life balance, which is important for me and my family and my kids. And that's what I'm going to do. I'm never going to have to deal with angry clients. So yeah, sign me up. Now I'm only going to make $100K, but you know what? That's fine. I don't care. That's enough for me. That's happening a lot. And enrollments are down for accounting as an entire industry. They keep going down like 4% a year or something. So like the supply is dropping off a cliff. So not only on the front end, at the top of our funnel, the supply is dropping, but at the bottom of the funnel, it's also like just a leaky bucket. And so what happens is there's fewer and fewer of us to provide services, which means that prices go up, right? Like we've been constantly increasing our prices, and clients get upset. But the reality is that I have to increase my prices because my CPA, the team of CPAs that I've hired to service all of you, can now go and get a job at another firm who's willing to pay them 20% more. So if I want to remain competitive, I have to increase their wages, and then I'm going to pass that cost on to you, just like any other business, right? And so that's what's happening in the industry, and it's happening very fast. And the faster that it happens, the faster that it'll probably get disrupted with technology. So we always try to be on the leading edge of technology, much to the dismay of some of our clients who hate that we change everything up on them all the time. But at the end of the day, we're trying to figure out how do we constantly provide great service while reducing total cost needed to get that done. Because if we can find that happy median, then we can keep prices relatively stable while the rest of the industry is jacking everything up.
Making faces here. This is a tough spot to be in for sure. Yeah, the technology is probably a huge deal. Do you see emerging technologies here that are going to, I don't want to say solve the problem, but at least help and alleviate some of this pressure?
Yeah, I mean, technology. The accounting industry is slow to change, so we're behind the curve on all technology. But there are changes. I mean, you see firms that are more cloud based now. You see firms that are using automation heavily. RPA, robotic process automation, is coming into play a lot more frequently. It's getting cheaper to implement. We played around with it last year, couldn't quite figure out how to make it work for us, so we put that on pause. But it's coming. So I think that the things that will really help accounting firms are going to be RPA and AI. And I don't know that the AI is really going to. I know that Chat GPT is like making waves and stuff, and everybody's like really excited about it, and I'm excited about it too. I think it's going to take a long time for an AI to do any form of tax planning or strategy for clients, because in order to fully utilize the AI, you have to know what to ask it. And honestly, like, that's the biggest part of the job. I can just Google better than you can related to this tax issue. and so I can give you the answer, right? And it's going to be the same thing with AI. But I think that'll really help, because it'll bring the cost of delivering like advisory services to clients down, which will mean more clients can get better advice, better tax plans at cheaper rates.
Yeah, we started playing with some of the AI stuff on our end. ChatGPT is my favorite party favorite for when people have no idea what that is. That's my current top function for that device, is to, hey, ask me to write something strange, and this robot will do it for you. But yeah, when we started to get into the technical aspects of what we do for investors, it's very bland and generic. So you're just not getting to, you're right, I can Google better than you can kind of set up right now. So we're just not getting to it yet. But it's coming. It's coming. We can do it. And man, we welcome it. Like, what a helpful tool in some aspects of the business, especially for some of the stuff that, frankly, we don't need to spend a lot of time on. Yeah, I could see some applications here. Somebody smart's going to figure this out for your side and my side.
Yeah, I was just experimenting with an AI, trying to plug my knowledge base into it so that we could use like a chat function for my team, so they could just ask questions and the AI would kick out answers based on our knowledge base. And it's not quite there. It's close. It's getting there. But I think that's the real first function that you'll see. And then think about it. You've got associates, tax associates that are fresh out of college that are able to spit out some sophisticated tax knowledge. That's what I'm hoping comes from this.
Oh, that's interesting. Yeah, now I'm thinking about the questions our staff ask us. What if they could just ask the bot?
Yeah.
All right. That could be interesting. Sign me up for that. Yeah. I had one more LinkedIn question for you on one of your posts that we skipped over, and I think it was really important. I know you wanted to talk about it too. What is sort of the vacation loophole here for some other income? So we have majority of our clients as well are real estate investors. However, a lot are W-2 or 1099 employees that are looking for passive real estate investments. And so they're facing, they don't have the advantages of this huge portfolio to offset against, or that professional real estate designation. How can they use sort of this vacation home loophole to help from a tax perspective?
Yeah, so the short-term rental loophole is good for anyone who is working a full-time job, running a business full-time, kind of at the earlier stages of building their portfolio, and actually want to own vacation homes. That's the real kicker, is you got to actually want to own the vacation homes. Otherwise, it's going to be a nightmare for you. So if you can meet those three criteria, then this type of, from a tax perspective, this is going to work great for you. So the context that you have to have before I explain the short-term rental loophole is that all rental activities are passive. There's two types of income. There's non-passive income, and then there's passive income. My non-passive income is my W-2 income, my business income, interest, dividends, capital gains. Even though that sounds like it should be passive, the code says it's all non-passive. So the problem is that my passive activity losses cannot offset my non-passive income. So my rentals are by default passive. And if my rentals create a loss, I can't use that tax loss to offset my W-2 income. Now, there's an exception to that. That is the real estate professional status. So if I can qualify as a real estate professional status by spending 750 hours and more time working in a real property trader business than I do anywhere else, then my rentals are no longer by default passive. The problem with real estate professional status is that I have to spend more time in real estate than anywhere else. So if I work a full-time job, then I'm not going to be able to justify that I spent more time working in real estate than I did at my full-time job. Like Brandon Hall, cannot be a real estate professional because I'm running a CPA firm for 2,500 hours a year. So there's no way that I'm going to be able to justify to the IRS or to eventually the tax court that I spent an additional 2,501 hours in real estate. There's just no way to justify that. So what that means for me is all of my rental activities are passive, and my passive losses will not offset my business income, my non-passive income, unless my spouse qualified as a real estate professional. If she was stay at home and didn't have a job, then she could qualify as a real estate professional. And then if we file a joint tax return, we have a joint real estate professional status tax return. So that's what a lot of our married filing joint people do, is they'll have the spouse qualify as a real estate professional. But regardless, if that's out of the equation, then what do you do? Because if your rentals are passive and they're generating passive losses and you can't use them, those passive losses just get suspended and they just carry forward. So it's not bad. It's just not tax optimal. So a way to get around all of this is to just sort of shift your investment focus until you can be more involved in real estate, or even better, in real estate full time. And what you do is you shift your investment focus to short-term rentals, because a short-term rental, if the average period of customer use is 7 days or less, then you do not have a rental activity. I'm doing air quotes right now, but rental activity. That's the key phrase. Yeah. Rental activities, because rental activities are passive unless you qualify as a real estate professional. But if I have a short-term rental, I don't have a rental activity. Therefore, I don't have to qualify as a real estate professional in order to make this rental activity non-passive. I just have to materially participate in my short-term rental. And material participation, there's 7 tests. I have to meet one of them. The 3 that we see most often met are: I spend 500 hours working on the short-term rental, I spend 100 hours and more than anyone else working on the short-term rental, or the time that I spend on the short-term rental is basically all of the time that anybody spends, meaning that I self-manage it and I do everything myself. If you can meet one of those 3 tests, then you are doing what they call materially participating. And when you materially participate in a trader business, it is a non-passive trader business. Now, if you just went and materially participated in a long-term rental, it would still be passive, because you first have to qualify as a real estate professional, because the long-term rental is a rental activity. But a short-term rental is not a rental activity. Therefore, you do not have to qualify as a real estate professional first. All you have to do is materially participate in the short-term rental, and now you can use the losses to offset your W-2 income. So at the end of the day, if I buy short-term rentals and I materially participate in them, then those are all non-passive, and I can create losses through cost segregation studies and bonus depreciation. And those losses can offset my W-2 income, because there's no hurdle on I have to work more in real estate than anywhere else, because I don't have to worry about qualifying as a real estate professional.
Ooh, oh, I like this. I like this a lot.
Did I do an okay job with that?
Oh man, there's a couple of things in there I want to piece out. I want to piece out really quick. So I think it's really important that you said, yes, this is a great tax strategy, but you got to want to own short-term rentals. And so we kind of beat this into people's heads, like, yes, economically, X, Y, and Z sounds like a great idea for you, but you do have to want to do it. So make sure that you got your mindset kind of tight. Like, yes, you do want to do this because you do have to do things to make this work for you
Yes.
economically. With
And
the cost seg study, and I know we've lost a little bit on the bonus depreciation law this year, 100% to 80%. Every dollar that I invest in that short-term rental, how much do you think is there from a loss standpoint that I could apply across other sources of income?
yeah, I mean, it really depends on what type of asset you're buying. I think if you asked a cost segregation company, they would say on a single family home, you can look at about 15% of the purchase price being allocated to 5, 7, and 15-year property. So 15% times 80%, whatever that comes out to be, is probably what you're looking at in terms of a first year deduction. And then depending on how much income you create, that depends on the tax loss that would come from that.
What do folks have to think about in executing that strategy and thinking about down the line of that short-term rental when they look to sell? They obviously would have to be thinking about 1031 exchange there, I would imagine. But there's going to be a tax bill there at the end they got to address.
Yeah, anytime that you take depreciation, which you have to take depreciation, it's not an option. The option is, do I want to accelerate the depreciation? But what happens is whenever you sell the asset later, you're going to have a larger gain that you have to pay tax on. So if I bought a property for $100K and then I sold it for $110,000, most people would say, well, there's a $10,000 gain. But a tax person is going to say, well, we bought the property for $100K, but we depreciated it 20 over the hold period. So the adjusted basis is 80. We sold it for 110, so the total gain is 30. 10,000 is coming from appreciation, 20,000 is coming from depreciation that we took previously. But we got to pay tax on the full $30,000 gain. And that the gain coming from the depreciation is called depreciation recapture. So we have to recapture depreciation. Bonus depreciation gets recaptured at ordinary tax rates. Straight line depreciation is recaptured at a maximum 25% tax rate. So it can hurt you on the back end for sure. But what we have seen with a lot of our clients is more of what we have seen from our non-institutional clients is more of just I'm going to buy this property and I'm just going to keep flipping it. I'm never going to sell this equity that I've put into this property. I'm going to put equity into property. I'm going to hold it. Whenever I'm done with it, I'm just going to 1031 exchange it. And I'm just going to keep doing that. Or I might even cash out refinance, and just keep holding the property. That's what we see a lot of. So I think that a lot of it's definitely something to be aware of, the depreciation recapture, this gain on sale on the back end. But I also think that if you plan ahead of time, it's probably overblown. I'm going to say that at risk of CPAs coming after me and saying I don't know what I'm talking about. But from my experience working with our clients, I think that the depreciation recapture conversation is overblown because most real estate investors don't just liquidate their portfolios. They 1031, they 1031, they 1031, then they die, then they hand it to their heirs. Then their heirs liquidate the portfolio, but they don't pay any tax when they liquidate because they got the stepped up basis. So that's what we see most of.
When you see that the constantly depreciating that asset, the basis on that asset's going to eventually go to zero. Does that become a problem if I'm not adding to my real estate portfolio, am I all of a sudden going to wake up someday and not have the kind of paper losses that I would expect from that portfolio because I'm not adding to it? Someday I'm going to wake up and I'm going to have, oh shoot, I don't have enough depreciation or losses here to kind of offset that rental income that's coming in. Do you see that happening if I'm not adding to the portfolio?
Yeah, I mean, when you stop adding to the portfolio, one day your depreciation will run out, and you will have taxable income, right? But you would also have to check yourself because all the while, you're talking 27 and a half years later. That's when depreciation is going to run out. Short-term rentals is 39 years. So we're talking decades of tax savings thanks to this depreciation that I've been claiming. And so the question would be, what did you do with the tax savings? If you went and bought a Ferrari, it's probably going to hurt at some later point, right? But what most of our clients do is they just reinvest the tax savings. And so they just create bigger and bigger and bigger portfolios. So sure, one day you might have to pay taxes, but paying taxes on $1 million income stream, who cares, right? I'm doing pretty, I say that as a tax pro, and again, I'm going to get flamed by the tax community for this, but Again, after taxes on $1 million, I'm still looking at 600K. That's pretty darn good. So you got to kind of keep some perspective.
Yep.
And from my perspective, it's a net present value issue. So I can literally go throw it into Excel, and I can show you what the net present value is going to be of taking a cost segregation study and accelerating that bonus depreciation versus not, versus, and I could show you like all the way to 40 years from now how much that depreciation has benefited you. So as long as you can keep that perspective, it's all going to be fine. But yes, at some point you will have to pay tax. Hopefully by that point you're so rich it doesn't matter.
Marking these things down. Take the Ferrari back. Send a letter of engagement to my CPA, because I was sending her a note like, hey, I want to pay you for this consulting, and then I quick deleted it. I'm like, oh no, we need an engagement letter. I got to tell her what I want her to do first before I start handing her money.
Yeah.
I've got a ton of follow-up items out of here that I have to do. Brandon, this has been awesome. I think we could spend the rest of the day continuing to talk, but I want to be mindful of the time. Where can people find you? What would you like to promote? How do people get in contact with you? If, they need this help and they probably need it really bad, how do people find you best?
Yeah, so there's two places. If you want to join our community and be part of this thing that we're building, we're trying to help people with their tax knowledge as well as their portfolio knowledge. You can find us at taxsmartinvestors.com. We've got a free gift for you. You have to pay for shipping. It's $30. But there's a lot of cool stuff in there. And then if you want to explore potentially becoming a client of the firm, you can check us out at therealestatecpa.com. Either one of those links will get you to me. But thank you very much for having me on the show. I appreciate it.
No, this has been awesome. Thank you so much for the time. I think people are going to find a ton of value here. Thank you again so much.
Thank you.
And thank you everyone for listening. Until next time, we will see you. Bye-bye.